Well, good afternoon and welcome to our annual budget review from the federal budget. So I'm Brett Griffiths and I'm joined here today with Kim Reynolds from our taxation advisory section of Vincent's. This is, I think, the 11th year that we've looked at the federal budget in some detail via a webinar, and the budget last night was, well, different in many regards insofar as it was lots of expenditure, but not so much about revenue. I think it's probably a fair assessment, Kim.
That's right. I think there was more a reliance on the cheap debt that's around at the moment rather than raising taxes to pay for all the spending. Yeah,
and I think they're also reliant heavily on the fact that the economy has recovered better than what they expected. So there was essentially using revenue that they didn't expect to be there, and turning it into, or it's just basically spending the revenue they didn't expect to have.
That's right. An example of that is the increase in the iron ore price that's contributed over the last 12 months, which is something that goes into, iron ore is something that goes into building infrastructure. So when there's ever a downturn around the world, then infrastructure is a key element, and we'll see a bit more of that from last night. But that's definitely contributed.
Yeah, and I suppose to sort of highlight that fact, in the budget we had in October last year, which is obviously unusual timing. I think they had estimated iron ore prices at around $55 a tonne. Currently, they're about 220, I think. So that increase means a lot more revenue from taxes, from the export of that iron ore.
Yeah, exactly. That's right.
So I suppose let's get into it, Kim, and let's start with personal tax. That's where people mostly worry about.
Yep. All right. Well, as Brett said, if we start with the personal taxes from last night, there was some chatter before the budget about whether the low and middle income tax offset would be extended, and it was confirmed last night that it would be extended to the 21-22 year. So this relates to that $1,080 offset that individual taxpayers get when they lodge their returns each year. It is a tiered system, so if you're earning between $48,000 and $90,000, then you'll get the full $1,080. And it tiers up until that point, but then it goes down from 90,000 down to 100. If you're earning 126,000, you don't get anything. So one of the, I guess, things to keep in mind with that offset is that it doesn't go back to the taxpayer until they've actually lodged their return. So even though it does continue until the 2022 year, individuals won't actually see it until they've lodged their 2022 tax return. So you've got it in the 2021 return, but also again next year.
And Kim, just to pick on one little point there, there's actually very little in this budget that wasn't already announced.
No, there was only, I think, one item that I'll talk about a little bit later that I wasn't aware of, but it was a very unsurprising budget in that sense. Yeah.
And look, to be fair, a lot of the super measures were new, but apart from that, pretty much the managing of the message had already occurred.
That's right. As far as personal tax rates are concerned, there was no change to that. You might remember that a few years ago, the government foreshadowed a staged process to reducing and changing the way that the personal tax rates were structured. We're currently in the middle of stage 2 of that program. Stage 3, the changes are still due to commence on the 1st of July 2024. So I've just set out there on a slide that the changes over the coming years. So the major changes will really be from that 1st of July 2024, when a lot of taxpayers will fall into that 30% tax bracket, and we'd lose the 32.5% and the 37% bracket. So one of the items that's been a bit of a bugbear for tax advisors for a number of years is relating to self-education expenses. The government announced last night that there would be some changes to the way that self-education expenses would be dealt with for tax purposes. So currently, the first $250 of deductions that are for prescribed courses of education aren't deductible, but the amount over that would be. So it applies to self-education expenses where they're in connection with you carrying on a profession or in the course of your employment and the like. So this $250 threshold is going to disappear, and it'll be relevant for the first income year after royal assent. So we've got to have the law introduced and passed, and the first income year after that we'll see that change. I think it's probably a potential lost opportunity here, this one, to make this a little bit wider to the community, because there's been a lot of talk about upskilling people. You know, there's older Australians, there's women going back into the workforce, and that lack of skilled workers. I think that there was an opportunity to maybe bring this forward a little bit and have it a lot wider, so that it encouraged people to skill up for potentially employment that they don't have at the moment. So taking away that connection.
I was going to say, removing that nexus that currently has to exist.
That's right.
Yeah, okay.
But we haven't seen the law yet, so they might surprise us.
I wouldn't be betting on it.
The next item that was on the agenda last night was in relation to residency testing. So this was a recommendation from the Board of Taxation back in 2019. For those of us that have had to deal with individual residency matters in recent years, it's becoming more and more challenging. Up until 2020, we were a very mobile population, people going all over the world for various reasons and for various lengths of time. So determining where a person was a resident or not was becoming, from an Australian perspective, becoming quite challenging, because most of our residency laws have been dictated by the decisions by the courts over the years. So to try and make this easier, essentially what the proposal is that the government will introduce what they've referred to as a bright line test. So basically, if you're a person that's been physically present in Australia for 183 days or more in an income year, then you'll be regarded as an Australian tax resident. There'll then be a second tier test, and so if you don't satisfy that first test, then you can also consider this second tier, which will include things like, you know, where your physical presence was, and some other measurable and objective criteria that we don't have the detail for at this point in time. Maybe very similar to what we've got as the current testing at the moment. So it's sort of flipping the current residency testing on its head. We do have a 183-day test, but it's a secondary test at the moment. So, and it's coming in line with what some other countries have. So the UK has something similar. Yeah. And again, it'll be effective from the first year after the date of royal assent.
I can't actually help to think that COVID has sort of focused the whole residency question a bit more in this budget, because not only, and as we'll touch on a little bit later, not only is there residency dealt with from a personal point of view, but also companies, trusts, and super.
Exactly. Yes, it's definitely focused the mind, I guess, the 2020 for all the challenges that it gave us. But residency has been an issue, particularly in Australia, for quite a few years now. Particularly for individuals, we've had quite a number of court decisions that have come down that the decisions very much depend on the facts of the particular case. So it's very hard to draw some sort of line and say definitively, I know that this person will be a resident because of this rule. It just depends on the particular facts of the individual.
Yeah,
hopefully this will make it clearer.
Okay.
In other personal tax changes or updates is in relation to the Medicare levy, the low income thresholds, applying for the 2021 year and later income years. I've just included a summary there of what those thresholds will be for this year and later years. The other item that impacts on personal taxes to some extent is the childcare subsidy. Now, this was announced prior to the budget, but it's a $1.7 billion package. It will apply from the 1st of July 2022. So if the purpose is the I guess the purpose is to increase workforce participation. It would be good if it was able to kick off earlier, but unfortunately there's still a bit of a lag there before it'll actually happen. So what this does is that it will change the level of the subsidy that's available for families that have got more than one child that's aged 5 and under in childcare. So currently the level of the subsidy is 85%, and that's going to be increased to 95%. And the annual subsidy for families that have got a combined income over $189,390, a very random number. I'm sure there's some logic behind it.
You'd hope so.
Yeah, that subsidy cap that's currently $10,560 is going to be removed. So the idea, the examples given last night in the budget papers were, a family earning $110,000, the subsidy for the second child, subsidy increase for the second child would be $95 a week. So they'd be $95 better off a week where they had 4 days worth of care. If you've got a family earning $80,000 with 3 children, then there would be a subsidy increase for the second and the third child. Again, $108 better off for 4 days worth of care. So it's still, I was listening to some of the commentary last night, and childcare expenses are quite significant when on a week-to-week basis. So this will go some way to helping people, but I don't know that it's going to be the answer to all people's prayers.
Yeah, well, I think it's interesting that essentially childcare is more expensive than private school education. So,
Right.
So when you, as a parent, when you take your child out of childcare, then all of a sudden you've got extra money there that either you can channel towards private education, or you can put it back into the family budget.
Yeah. Okay, so I'm going to have a rest for a minute, and you can talk about super.
Sure, sounds good. So the first thing I want to just mention on super, there was really only 4 or 5 things that superannuation related topics that were addressed last night. So super guarantee was one of those. Now, there had been some speculation before the budget that the government was going to propose that they remove the increase of the super guarantee from 9.5% where it currently is, not increase it to 10% as currently legislated. So that didn't happen. So the first thing is that that super guarantee will be 10% from 1 July this year. What they've proposed is that from 1 July 2022, the current $450 threshold that you, as part of a criteria to enable to be paid the SG, will be removed. So currently you have to be either 18 or older and earn more than $450 per month to receive SG. What they're proposing is to remove that $450 a month. So if you think about someone who is a casual worker, or if someone has multiple employers, then they may now start to receive superannuation where previously they have not.
And a lot of those workers would probably be covered by awards as well, and those awards are exclusive of super.
That's right.
Pay, so it's an increase to the cost for the business.
That's right.
Well.
Yeah. So if you think about a hospitality business that they might employ a lot of casual employees, so typically they're going to be probably in their late teens, early 20s. Now essentially they're paying potentially an extra 10% tax or 10% expenditure on that on their wage cost.
On that worker.
Yeah,
right.
And also payroll tax comes into it as well.
Yes, that's the additional consideration.
That's right.
Exactly.
So it's, and obviously, Kim, we were talking before about how they're trying to increase wage growth in this budget, and there's some measures in here where they've tried to do that, where this is almost counterintuitive to that because it's not wage increase, but yet it's cost of business increase.
Exactly. There's a very long tail before you actually get any real benefit from it.
typically for those that are going to be utilising this measure, a very long
Very
tail.
long tail.
Yeah. Another announcement from last night's budget is the proposed removal of what's known as the work test. So currently we have this notion inside super where if you're over age 67, if you work more than 40 hours and 30 consecutive days, you're still able to contribute to super. Now what they're proposing is that to remove that work test requirement for making non-concessional contributions and also salary sacrifice arrangements. So if after age 67 you can no longer make personal concessional contributions, so where say you've earned dividend income and you want to put money into super and claim a tax deduction, that's not what they're proposing. You still have to meet a work test to do those contributions.
Okay.
What they're proposing is essentially where you are actually employed, so you're receiving that SG contribution that we're just talking about, or you want to put in after tax money into super, then you don't have to meet this work test requirement.
Okay.
Now,
it's a little bit counterintuitive, isn't it, really? That if I'm earning passive income, I still have to satisfy the work test, so I may not be working. But if I'm getting SGC, I'm probably working.
Yeah, well, the reason
I'll be able to satisfy the work
that's
test.
right. But see, the reason why they've done that is that there are limits into how much you can get into super as a non-concessional contribution. So not only each year, but also once the member's balance reaches 1.6 million currently, soon to be 1.7, you can no longer put any more money into super as a non-concessional contribution. Those rules don't apply for concessional or tax deductible contributions.
Right.
So it's a way that they can limit how much you can put into super and take into account the fact we've already got this $1.6 million threshold as such.
Yeah. Okay.
So they're playing with the system. Essentially, they're making it more confusing than what it currently already is. No surprises there. Excuse me. And just what I find a little bit interesting around this is they're also saying that the bring forward rule will be available to people, even regardless of age. So for argument's sake, if you could be 80 and put currently $300,000 into super, but not put anything else in for the next 3 years. Now, at the moment, there are age restrictions around that, and there's actually a bill before Parliament to increase that age for that bring forward rule from 65 to 67. So presumably that bill will now just lapse and get pushed to the side, and they'll start again. Okay. So because there was some sticking points inside the Senate for that older bill, so I think they've sort of worked around it, so to speak, in this one.
So probably nothing to do on that this financial year, but next financial year there might be some planning issues to think about before July the following year.
Yeah, and if nothing else though, Kim, what it does is it emphasises the fact that old bill that's currently in the Senate, we're not going to see before this new one comes in.
Yeah.
So from that point of view, it is actually a planning certainty.
Okay.
Downsizer contributions, they've announced some tweaking around that. So essentially reducing the age in which you can access this notion of a downsizer contribution from 65 down to 60. So the other measures still apply. So it still has to be your principal place of residence, own it for 10 years. The contribution has to be made within 90 days of settlement, and you still have to do the form, as well as not previously utilised this downsizer contribution. But what it does allow is $300,000 per person, or $600,000 for a couple, to put money into super, and that transfer balance cap, the $1.6 million I mentioned, that doesn't come into it, so that's excluded. So you could have $2 million into super, sell a house, or sell your home, I should say, that you've owned for more than 10 years, and as long as you're over age 60, you can actually add $300,000 into super. So currently that's 65. They're now changing that to 60, which I think is a good, sensible measure.
Yep.
And we're talking about residency before, Kim, so they've also announced some proposals around the residency of self-managed super funds. So from 1 July 2022, there's currently a safe harbour rule where if you intend to go overseas for no more than 2 years, you don't have to worry about the residency of your super fund. So it's called the central control and management remains in Australia. They're going to increase that safe harbour from 2 years to 5 years. So essentially, you can still be managing your self-managed fund for 4.5 years from overseas.
Okay.
So you don't actually have to be physically in the country. So that's a positive change. Once again, I think COVID's probably had a part to play in all of that. There are things you can still do to work around it, if I can put it that way. So you can put an enduring power of attorney in place, for example, and they literally step into your stead as trustee if your intention is to go for a longer time than currently 2 years, proposed to be 5. And the important thing there is it's the intention when they leave. So if the intent is to always come back, then that's where this 2-year thing applies. If the intent is to reside permanently overseas, then they that 2-year safe harbour does not apply. It's from the day they leave.
Okay.
And also this notion of an active member. So active member is essentially like an Australian resident that receives contributions or rollover. So for APRA regulated funds, so the bigger funds, that's not a problem because they have a very large member base. So typically they're going to be active in Australia. For self-managed super funds, that's a bit different because as soon as you have someone who is overseas and they contribute to super, then that could potentially be a problem. And typically it is. What they're proposing is to remove this notion of active member. So you can be overseas and make rollovers into a self-managed fund or contribute to self-managed fund, and that's okay. So it creates it removes a lot of complexity around that residency idea. So like you're talking with individuals, it makes it simpler, which is a good thing.
Yeah. Still requires some planning beforehand though.
That's right. Another thing that really doesn't impact too many people, but it's worthwhile mentioning because it's certainly a big issue for some, is that there are these old type of pensions that have been around from basically 2006 prior, called market-linked pensions, lifetime complying pensions, or life expectancy pensions. And these are known as non-commutable pensions. So in other words, they're locked in. You can't actually change them. You had 6 months when they first started, but after that, that's it. You're locked in. Given the changes that occurred in 2017 around this notion of transfer balance cap, the government have finally recognised that some people are very disadvantaged by having these type of legacy pensions, as they're known in the industry. So they're proposing to allow a 2-year window in which the people with those pensions can roll back into an accumulation phase to then start a pension again if they so choose. The trick will be in relation to the lifetime complying pensions and the life expectancy pensions, because they have what's called a reserve in them, and that reserve is to allow for the ongoing funding of the pension. That reserve is actually going to be taxed at 15% when it flips back into the accumulation phase. So, we've got a fund that has a reserve with $1 million in it, so that'll be $150,000 tax that they'll have to pay when it flips back into accumulation phase.
Okay.
So some detailed analysis on a case-by-case basis will be required for that one.
Okay.
Over to you, Kim.
Okay, so we'll look now at some of the business taxation measures that were announced last night. The first one is in relation to the temporary full expensing. So we'll all know this because of the work that's been done, or the measures that were introduced over the recent years to encourage businesses to buy depreciating assets. It's It's very generous, this particular full expensing mechanism, but because it allows investment in capital assets by businesses. There are various incentives that are provided during difficult times, and this is just one example of those. This particular one was due to expire on the 30th of June 2022, but now that's been extended to the 30th of June 2023. So all the other elements of the measures are going to be unchanged. So eligible businesses that have got an aggregated turnover of under $5 billion, they can deduct the full cost of the eligible depreciating assets acquired after the 6th of October 2020, so last year's budget, and first used or installed ready for use by the 30th of June 2023. And I guess just for those accountants that are listening, it's worth having a close look at how those rules work, because they're not necessarily simple as the way that they interact with other provisions in the Act. So one example is that these rules do supersede the normal small business depreciation rules or depreciation under Division 40. So it's worth having a closer look at this. There's something I was listening to on the weekend. There was somebody talking about these full expensing rules and encouraging people to buy capital assets. And an example that was given was farmers going and buying tractors. And go and buy your tractor and get a full deduction for it. And that was great, except that AgFest was on recently, and the John Deeres and the like of the world wanted to have stock to show people at AgFest and couldn't get stock into the country. So they were asking farmers if they could borrow their tractors back so that they could show people what these products look like. So yeah, getting stock might be a bit of a challenge for some people, I think.
We only have to have a look at the new car sales over the past few months to see where that's gone.
Yeah.
Obviously utes are one of the biggest selling motor vehicles we have in the country.
There's a lot of those.
There's a lot of those. And also car manufacturers are having trouble getting parts, so computer chips for their cars. So it's an interesting measure, and you would think that a lot of businesses may have already utilised that. So don't know, even if they can get supply, whether they will need to, because they may have already done it.
That's right. Well, this extra time gives them time to actually get it into the country.
Yeah, true.
As well. So
yep.
Fingers crossed. Okay, so the other measure that was talked about last night was the loss carryback rules. Now these rules are available for eligible companies that have got an aggregated turnover up to $5 billion, and they can carry back a tax loss for the 2020, 2021 and 2022 income years to offset tax that was paid in the 2019 tax year or later years. So this measure's been extended to the 2023 income year. It's basically been put in place to assist with cash flow for businesses that did suffer losses during COVID. So it'll be available when the company lodges its tax return for 2021, 2022 and 2023. One of the things that I guess I wondered about this, and it's obviously an important measure to keep in mind, given that we're in tax planning season at the moment, and we need to be able to make sure that we're taking advantage of it to the extent that we can. You do need to keep in mind, though, that it's not available for trusts or for sole traders, so it is purely a company measure. And I guess there are some mechanical things within the tax provisions as to why it doesn't apply to these other taxpayers, but it is purely a company measure. You do need to be careful, though, that those rules mean that the loss carryback can't be more than the earlier period losses, the earlier tax profits. And the loss carryback amount can't give rise to a franking deficit in your franking account. But again, like I said, keep in mind for tax planning this year. One of the other announcements last night was in relation to employee share schemes. Now, these have become increasingly popular in recent years, and one of the issues that we always need to deal with with employee share schemes is, when is the taxing point? So sometimes a particular scheme might be taxed, as the employee, you may be taxed up front, or you may be taxed at a deferred point in time. And those trigger dates will relate to the earlier of one of 4 particular points: the cessation of your employment, or where there's no, what is referred to as a risk of forfeiture, or no restrictions on the disposal in respect of shares, or where an employee exercises an option and there's no risk of forfeiting the resulting share and there's no restrictions on that disposal, or a maximum period of 15 years. Now, that cessation of employment trigger is going to be deleted, it's going to be removed, so it'll really only be the other 3 trigger points that will apply. It'll only apply to employee share interests that are issued to employees after royal assent for this legislation. There are some other issues in the employee share scheme rules that probably also need to be considered, probably a wider discussion really, but you can have situations where when you exercise an option, that can be a taxing event, and the taxpayer might be forced to actually sell the shares to actually fund the tax payments. So that's a little counterintuitive, I guess. And also situations where you might exercise an option and then you need to hold the shares for an extra 12 months to be able to gain access to the 50% discount. So those couple of things make it difficult to manage the tax cost in some situations, but just something to be aware of if you're dealing with them. Fingers crossed at some point those rules might change a little. There's also a proposed change that may impact on those employees that salary sacrifice for employee share schemes. So there's an increase in the value of shares that can be issued to an employee under these simplified disclosure requirements. Currently that threshold is $5,000, and that's going to be increased to $30,000. So that will hopefully open up the employee share schemes a little wider for employees. And this is one of those areas that I did get a little bit of a surprise about last night. So in relation to medical and biotech patents income, the government has proposed a concessional corporate tax rate, and they've done this by way of a patent box tax regime. So essentially it's a quarantining of income that relates to particular patents that are developed in Australia, and the corporate tax rate that is going to apply to those patents will be 17%. So as I said, it's going to apply to income that's derived from Australian medical and biotech patents. The detailed design of the patent box is obviously going to be subject to consultation. We don't have that detailed yet. And it is a concept that they are willing to consider to support the clean energy sector as well. It's going to apply for income years starting after the 1st of July 2022 for patents that are applied for after last night. So it's something that patent boxes exist in a number of countries in Europe and have for a number of years. So it's not a completely new concept, but it will hopefully encourage people to develop technologies and patents here in Australia and keep them here as opposed to moving overseas.
I must admit I hadn't actually heard of this concept before, Kim, but I actually think it's a really good idea.
Yeah, I think it is too. If you're trying to encourage innovation in your own country, we have R&D. It goes some way towards doing that, but I know from our experience, I know we've had clients in the past where they've got to a certain point and then they've had to go overseas to get to that next level. So hopefully this will encourage people to stick around. I am curious as to why it's been limited to these 2 particular sectors. There was pretty much only COVID. I hardly heard any discussion last night in relation to clean energy, the clean energy sector generally, and the medical and biotech patents. Completely understand why they're needed, etc., but it did seem to be a bit of a new shiny thing, or the current crisis sort of thing, that I didn't see why it shouldn't be opened up to wider areas, because we've got skills in a whole lot of different sectors that can benefit the country. I mean, you only have to look at, Wi-Fi came from here, the cochlear implant came from Australia. So we've got a pretty clever population, so we should leverage off that.
Yeah, I can't help but wonder if maybe some of it relates to the in the budget last night they announced infrastructure for or funding for infrastructure for an mRNA vaccination plant.
Yes.
So I wonder
uncosted.
Yes, that's right, because of commercial sensitivities.
Yeah.
But I wonder if that might have something to do with this as well.
Potentially, yeah, that's right. All innovation is good, I guess, but the narrowness did surprise me a little. We've been talking a bit about residency in the context of personal taxpayers, superannuation funds. Corporates don't miss out. So it was announced last year that the law would be amended to provide companies that are incorporated overseas to be considered to be Australian residents for tax purposes, where they've got a significant economic connection with Australia. And that would look at what their core commercial activities are that are in Australia and where the central management and control is in Australia. Now, this is essentially to reflect the position that existed prior to a High Court decision referred to as Bywater. And there's been a lot of confusion in recent years as to how this works, and hopefully this change in legislation will get us all back to some sense of normal. The date of effect is going to be the first year after the legislation receives royal assent, but there is an option to apply the new law from the 15th of March 2017, which is when the government first essentially acknowledged that this was an issue. The government's also considering broadening the amendments on these residency rules to trusts and to corporate limited partnerships. And they've said that there'll be consultation to come in relation to that. Because at the moment, those, I deal with trusts quite a bit, and the residency of trusts can be quite challenging as well, because it just depends on where one of the trustees are. If that's an individual, then you have to look at the personal residency rules. If it's a company, you need to look at the corporate residency rules. And so it'll be good to have some sort of alignment throughout all of the entity types. And
if the government acknowledged it was an issue 4 years ago, it's good to see expediency has played a role here.
Oh, I've got other examples of that. Yes. Yes. Some other measures that were announced last night was a tax exemption for some qualifying grants that were made to businesses that were affected by the storms and floods in early 2020. So small business recovery grants and private producer recovery grants that were provided, they'll be treated as non-assessable, non-exempt income. In the not-for-profit sector, there's what they referred to as tax exemption transparency, an online system. Now, there are some non-charitable not-for-profits, so those not-for-profits that aren't registered with the ACNC, that can self-assess their eligibility. And at the moment, they self-assess that on an annual basis and don't have to report that to anybody. They don't lodge a tax return, so there's no mechanism for the ATO to get any read on whether they've satisfied their eligibility requirements or not. So from the 1st of July 2023, income tax exempt not-for-profits that have got an ABN are going to need to submit an online annual self-review of their eligibility assessment. Potentially not unreasonable. Transparency, I think, is the key word there, but another avenue another thing for not-for-profits to actually think about. Greenfields exploration incentive, just briefly, this has been extended by another 4 years to 30 June 2025. This is essentially a tax incentive for the exploration of greenfields, as the name suggests, where a portion of the tax losses can be converted and distributed to investors as refundable tax offsets or as franking credits.
So essentially that's for mining.
Exactly, for mining, yeah. A couple of more specific items, I guess. Excise changes for small brewers and distillers, because there's not enough craft brewers around. So from the 1st of July 2021, there will be some changes in relation to the excise rules. Currently, they receive a refund of 60% of the excise paid up to an annual cap of $100,000. there'll be a full remission of the excise that's paid up to an annual cap of $350,000. So this more aligns it with the wine equalisation tax producer rebate. Now, there's some messiness within that rebate as well, so I'm not quite sure that this is the most efficient way of dealing with this, but at least the two, if you're going to have a problem in one, just make it consistent across the two, and then hopefully fix them up at some point in the future. But as far as the brewers and the distillers are concerned, it's positive news.
What I find a little bit ironic around this, Kim, obviously alcohol consumption or private alcohol consumption has increased over COVID. This is actually one of the few measures that commences from 1 July 21. Yes. Most of the other measures in the budget were from 22 onwards, so they're allowing time to navigate the whole parliamentary process, whereas with this, they know they can just get it straight through.
Quite possibly, that's right. And another one of the example of how priorities might work, New Zealand sporting teams.
The Warriors rebate.
Yes, the Warriors rebate. The government has said that New Zealand will retain primary taxing rights in relation to Australian income tax and FBT liabilities that arise due to teams that have been required to be in Australia for more than 183 days. New Zealand Warriors is the prime example. So just to, I do feel for some of those guys. They had to be away from home for a long time, and but yes, they're from a residency perspective. There were all sorts of questions that were raised, but this will hopefully address that. It was interesting that you call it the Warriors rules, but the same approach hasn't been adopted for business executives that might be in the same position, whether they be from New Zealand or anywhere else in the world. So it really is targeted towards the New Zealand sporting teams.
Is that because the All Blacks have been sold off to American private enterprise?
I don't know, but yeah. And I think that the last thing that I really wanted to talk about at the moment was in relation to the specific tax measures was the tax compliance and integrity measures. There wasn't a lot in here either. Small business is able to pause a disputed ATO debt recovery. So at the moment, it's a pretty costly process to get the ATO to pause their collection of debts that might be owing. So the AAT is actually going to have the power to enable to put a pause or modify the ATO debt until the dispute's been resolved by the AAT. It's going to apply to small business entities, and it's going to have effect from the date of royal assent. Also, an early engagement service. This wasn't actually mentioned in the budget papers. It's in an information sheet that I found, and it's available for first-time foreign investors. It's going to be supposed to be used to encourage and support new business investment into Australia, and a service that will be available from the 1st of July that will allow people that are coming into investing into Australia to actually understand what our rules are and how they impact on those investors.
Good luck.
Yeah, that's right. Okay, so not a particular, not tax related necessarily. There was a large announcement a couple of weeks ago now in relation to the digital economy. It's a $1.2 billion investment that's being proposed for this digital economy, which I actually thought we were already in, but I guess it's
the government's not.
It helps to develop these, the skills that we need, but also different aspects of the economy that are going to rely on it. And I think 2020 has shown that we do rely on even more. So it's part of that accelerated digital transformation that we've had to go through in recent times. It'll concentrate on increasing digital skills across the board. Artificial intelligence, there's going to be a National Artificial Intelligence Centre, and it'll encourage the adoption and the use of AI, particularly in small business and businesses generally. So that will be interesting to see that developed, because I'm a bit of a nerd, so that'll be exciting. Enhancing government service delivery, so things like the MyGov portal and My Health Record, etc. That will get some attention. Some incentive investment incentives, which I'll look at shortly, SME digitalisation, emerging aviation technology. I did wonder what this was, but it seems to be looking at ways that aviation technology might benefit more regional areas, and also looking at drone regulations, so to get those more consistent across the country, to get that to, I guess, service delivery, etc. Data in the digital economy, I'm really not sure what that means, because it's it's all encompassing, really. It's just the world we live in at the moment.
Well, my understanding, Kim, is they're talking about actually setting up data centres.
That's part of it.
Yeah,
yes,
which is interesting, because essentially that's what private business do at the moment. So it's the government are actually going to be creating data centres, I believe, for small businesses to use.
Right. Okay. There'll be some private businesses will be happy about that.
Yeah.
Cybersecurity, safety and trust. So there's an increasing focus on cybersecurity. We're seeing more and more examples of those issues in the news on a daily basis. So obviously it's an important aspect of what needs to be considered. So one of the incentives that's going to be introduced is a digital games tax offset. So for all the gamers out there that want to get into developing, here's your chance. So from the 1st of July 2022, there's going to be a 30% refundable tax offset available.
So the Fruit Ninja people are about 5 years too early.
Exactly right, yes. Yeah. The minimum spend needs to be $500,000. The game expenditure needs to be qualifying, and that will be determined. It can't have a gambling element to it, and there's a few other pieces to that puzzle, but yes, it does need to be qualifying expenditure. And the offset's going to be available for Australian resident companies and also foreign resident companies that have got an Australian PE. So I guess this is something that some businesses might actually be using the R&D incentive for already, and there will likely be an interaction between the two. It'll be interesting to see how the numbers actually crunch to see what benefits that you get, whether if you don't take this up but only use R&D, whether you might be better off depending on what your mix of expenses are. So yeah, the devil's in the detail. As
always.
That's right. As I said before, there are a number of announcements around that have been here with us for quite a while, that something's actually actioned on. Intangible assets. This announcement was previously made in 2015 and then went on the back burner and has now come back to life again. What this change means is that the effective life of depreciating assets for intangible assets, you'll be able to self-assess or use the statutory effective life. So it'll apply to intangibles such as patents, registered designs, copyrights, and in-house software. And it really aligns the tax treatment of those assets with more tangible assets. It's going to apply to assets that have been acquired following the completion of the temporary full expensing rules, which is 1st of July 2023. So to me, this makes a lot of sense, because the businesses and technology is moving so quickly that having these statutory effective lives that were set a number of years ago are now no longer potentially realistic for some industries. So being able to self-assess that effective life, I think makes a lot of commercial sense.
Yep.
Now, some other measures that were...
Get that to work.
It's having mouse problems.
I'm having mouse problems. There we go. Sorry.
There we go. Some other measures that were released in the context of the digital economy. There'll be some venture capital concessions. There'll be digital cadetships offered, so on formal training as well as on-the-job training being provided. As I mentioned before about MyGov review and overhaul of the digital ID system. For those of you old enough to remember, there was an Australia card that was mentioned. It was going to be a plastic card that was going to sit in our wallets. That's probably not going to be needed, because we're going to have a digital ID system. There'll be a national standard. There'll be the proof of ID for foreign nationals and companies. I think we're all realising at the moment with the setup of MyGov ID, etc., that if you've got somebody that doesn't have particular Australian documents available to prove their identification. It's difficult to get that sorted because you've got to get original documents signed at a consulate somewhere in some other country, etc., and then send those originals to the tax office or wherever to get everything sorted. These areas are supposed to be streamlined better over the coming years, and also the move more towards electronic invoicing. Okay, I'm going to have a rest now, and we can talk about aged care.
Sure. Just before I do that though, Kim, we've just had a question from Neil in relation to the utilisation of the downsize provisions and the non-concessional contribution bring forwards.
Thanks, Neil, for asking a super question.
And he's basically just asking if you can use both of these measures in the one financial year. So essentially, the simple answer is yes, because they are very independent in how they operate. So if you were to sell a house and you had, call it $1 million worth of free cash available, you could actually make a non-concessional contribution and a downsizer contribution, so long as you are eligible to do both. So for the non-concessional, you hadn't previously used the bring forward, you're currently under age 65, and your super balance was less than 1.6 million at the previous 1 July of the previous financial year, and those downsizer provisions that I mentioned. So you've got to make sure that you meet those individual criteria, but so long as you do, then yes, you can put $600,000 into super per member. The thing to bear in mind is around timing. So let's say, for argument's sake, you currently had, I'll keep it simple, $1.5 million in super. You made a non-concessional contribution today but didn't make a downsizer until July, that would be okay. But if you did the downsizer first, then your balance would be greater than 1.6, therefore excluding you from making a non-concessional contribution. So getting that timing around the end of the financial year can be quite important. So just something to bear in mind there, Neil. Moving on to aged care and the NDIS. Look, I'm not going to talk a lot about either of these two, but if you have a look at the paper that we've produced that you can, that's available for you to download from here, then you'll actually see that we've covered the aged care proposals in a fair bit of detail. Obviously, this is a lot of money that they're looking to spend on aged care on the back of the Royal Commission into aged care and the issues that industry is facing. So they're proposing to spend $17.7 billion across 5 years, and that's both in this idea of a home care measure, so where people are being looked after at their own home, and also in residential care, so where they might go into a facility. For residential care, not only is there additional funding that they're putting forward, but also they're changing requirements in relation to frontline hours care per person, some of it which has to be, I think it's 40 minutes a day for a nurse, introducing a star rating. So if you think about food and how we have a 5-star rating, introducing a star rating for providers of aged care and facilities. So trying to make, I think, the industry more transparent, and also to ensure that our older citizens are better cared for, essentially. And also with the NDIS, an additional $13.2 billion up until 2024 to allow for the National Disability Insurance Scheme. So I believe, I haven't actually verified it, but last night there was some commentary around saying how we're actually spending as much on NDIS as what we essentially do on Medicare. So it's becoming a very big part of our budget, and obviously an important part, but a very big part of it. And it'll be really interesting to see where that goes, Kim. Obviously, we've had a Medicare levy for a very long time. There's been talk about an NDIS levy. There's been talk about an aged care levy. So whether we actually see something like that in the future, is probably likely.
Quite possibly, you know, both Labor when they were in government and the coalition now say that the NDIS will be and remain fully funded. So when you've got both sides of the aisle making those comments, it's very hard for them to not have it fully funded. And as far as I can tell, money hasn't grown on trees yet. So I think it's going to have to come from somewhere.
Yeah.
And a levy like that makes some sense. Yeah.
Well, and as part of the budget papers last night, they actually had the history of income or revenue and expenditure of the budgets over the past 50 years. And it was interesting to see that back in 1971, the revenue was 20% of GDP and expenditure was 8%, whereas this budget, essentially it was 22% revenue of GDP, but 38% of expenditure. So clearly we're spending a heck of a lot more now than what we ever used to, but not really generating as much revenue as a proportion of GDP.
Yeah, that's right.
Once again, infrastructure gets a Guernsey. So about 4 years ago, they announced that they were going to be spending $50 billion on infrastructure. They called it the infrastructure budget. Well, now we're up to 110 billion over the past decade. Interestingly, there's a lot of infrastructure spend that doesn't actually get spent. So they propose to spend it, but because of either issues around the proposed development, so it might not get out of the ground or it might be delayed. Think of the Inland Rail, for argument's sake. State governments may get in the way because they don't see the benefit in certain projects right now or don't have the funding for certain projects. So there's actually this notion of $110 billion is, well, rubbery, I believe, to say the least. But regardless, what they're talking about for Queensland in particular is spending $400 million on the Bruce Highway, more for up north. I think that's around floodproofing. Right down to some money for local roads and also the Gold Coast in relation to their light rail project, Series 2, I think it is, and also rail improvement from Beenleigh down to the coast. So they're continuing to spend money on infrastructure. The idea is around job creation. The problem is these projects take so long that I think it's hard to really see the real true benefits of that around the notion of unemployment.
Eventually you see them, but there's a lot of people working on them in the meantime.
Yeah, that's right. That's right.
Okay, so that's our wrap up of the budget from last night. As Brett mentioned, and some of you will have seen, we've released our annual budget report. You can find it on our website. There's a link there on the slide as well, which you can also download.
Yeah.
There are two reports there. One's I guess a summary report that gives an overview of everything that happened last night, so the social, economic, changes as well as the tax changes. And then there is a tax and accounting paper that we put up there this morning that gives a bit more detail on the specific tax and accounting measures that were announced last night. So if you just want to look at those measures, then there's a separate paper for that. So if you've got any questions that arise out of the presentation today, or anything that comes up in the next little while as we get a little bit more detail in relation to these budget announcements, some of them we might get legislation pretty soon. Others might take a little bit longer, so keep an eye out for them. And if you've got any questions along the way, feel free to reach out to Brett or myself, or your Vincent's advisor, and we can assist you where we can.
Yep. And just a reminder, Kim and myself's details were at the beginning of the slide deck here. So if you need to reach out to us, that's where you can find us. And excellent. I think that's it.
That's it. Okay. Thanks, everybody.
Thanks
Have
very
a good
much.
afternoon.
Cheers.